Good afternoon, and welcome to the AFS Best Practices Leadership webinar. Thank you for joining us today. Our topic is A Year Like No Other, Commercial Lending in 2020. This webinar will be approximately an hour long, and our speakers today are Don Doherty, Jeremy Charleston, and Rob Lynch, all from the AFS Business Intelligence team. Before we get started, there are a few reminders for today's events. We encourage questions. Please use the Q&A feature to ask your questions. We will leave some time at the end of the presentation so that we may answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar as we review the 2020 commercial lending landscape. We here at AFS sincerely hope that you, your families, and your coworkers are doing well in these very challenging times. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out to us with your questions. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. This database is also used to prepare our Pricing Trends monthly newsletter. Again, please reach out to us if you are interested in learning more about our pricing service or if you are interested in receiving our monthly newsletter. As we move to slide 4, today we will be reviewing results through the fourth quarter with a focus on loan growth, pricing and fees, and credit risk. A quick housekeeping note. Unless explicitly noted, all charts in this presentation exclude the Paycheck Protection Program PPP loans. To get started, we move to slide 5 and look at the main economic drivers of commercial loan growth and pricing. In terms of the overall economy, 2020 was a year like no other. As shown by the top left chart, real GDP collapsed in the second quarter as measures to control the spread of the pandemic shuttered many businesses. Despite a strong rebound in the third quarter and continued expansion through the fourth quarter, real GDP for the full year of 2020 was down 3.5%. This was the first full year contraction since the Great Recession and the worst plunge since World War II. Looking at the top right chart, we see the pandemic's impact on employment levels. The unemployment rate surged to nearly 15% in April and then gradually declined as the economy reopened. More troubling is that the trend has plateaued in recent months, hovering around 6 to 7%. This is an important driver because historically, the unemployment rate correlated very strongly with measures of commercial loan credit quality. Moving to the bottom left, we have the yield on 10-year treasuries, which plummeted last spring as investors flocked to safe assets. As we'll see later on, the average yield on commercial loans followed a similar trend. During the fourth quarter, yields on 10-year treasuries edged higher but remained near historic lows. Finally, the bottom right presents the Industrial Production Index, which is analogous to a GDP-like measure for the manufacturing sector. Much like the trend in real GDP, industrial production has yet to fully recover from the sharp contraction in 2Q. A challenging economy means a challenging environment for commercial loan growth. And more than ever, banks will have to be certain that they are pricing adequately for the credit risk in their loan portfolios. Moving to slide 6, one of the key themes in today's webinar is the sharp pullback in commercial loan growth. While there is no single cause, an important driver is that banks have become much more cautious and selective about where they extend credit. The source of this chart is the Fed's Senior Loan Officer Opinion Survey, and it plots the net percentage of banks that tighten standards for C&I loans. When the trend line exceeds zero, a larger number of banks have tightened standards versus relaxing standards. As the economic recession took hold last spring, banks responded by significantly tightening underwriting and lending standards used to approve loans to large and middle market companies. An interesting footnote in the latest report states that across borrower size segments, some banks actually ease standards for larger corporate borrowers. Keep this in mind as we look at loan growth trends a few slides from now. Moving to slide 7, we realize that the impact of the pandemic was not uniform across the economy. Sectors like e-commerce actually benefited from stay-at-home orders, while sectors like lodging were clearly hurt by such measures. The table here lists industries impacted by two major market forces. The first is COVID-19, which has resulted in a large number of people working remotely with an increasing reliance on e-commerce. Borrowers in industries with a check mark for these factors are likely to experience challenges growing their business and servicing their debt in the coming years. At the same time, ESG considerations, which stands for environmental, social, and corporate governance, are changing the way we think about lending to sectors like oil and gas. In today's webinar, we will focus on the COVID-19 related factors, the first two columns shown, and examine how they have reshaped the commercial lending landscape. Moving to slide 8, in upcoming slides, we will present how trends differ between a collection of industries we're calling COVID sensitive and the rest of the market. While narrowing down the list of affected industries is challenging, the 7 sectors you see here align with the framework depicted on the previous slide. The first affected industry is healthcare facilities, which includes hospitals, nursing care facilities, and doctors' offices. In terms of COVID cases, the pandemic has had a disproportionate impact on nursing homes, while hospitals and doctors' offices were negatively impacted because many elective surgeries, which are a key source of income, were postponed. And the stay-at-home orders impacted hotels, leisure and recreation, and leisure travel industries. On the right, we have oil and gas, an industry on shaky footing even before the pandemic struck. Limited travel and less demand for oil sent oil prices into negative territory last spring, further compounding the woes of this troubled sector. And finally, with unemployment remaining high, many consumers cut out discretionary expenses like eating out and non-essential retail. For your reference, we included a mapping table in the appendix specifying the NAICS codes used for each of these sectors. As we move into the loan growth section on slide 10, we begin our review with a long-term perspective on C&I loan growth. Note that this chart is from the Federal Reserve H8 release and includes PPP loans. To say that C&I loan growth in 2020 was volatile would be an understatement. A couple of key events help explain this volatility. First, in March, commercial borrowers, especially large syndicated borrowers, drew heavily on lines of credit to shore up cash and brace for disruptions at the onset of the pandemic. Second, the government launched the PPP program in April, and the influx of loans issued as part of this program further inflated total C&I loan levels. In the months that followed, C&I balances began a sharp and consistent downward trend. Many of the larger end borrowers that tapped lines of credit in the first quarter paid down their lines. And on the supply side, banks tightened lending standards and in some cases restricted the supply of credit to riskier industries. Still, due in large part to the PPP program, the C&I balances finished 2020 at higher levels than they started. Excluding these PPP loans, C&I balances were down for the full year of 2020. Today, we will shed some light on how this downturn is playing out across the market segments. Moving to slide 11, although most of the focus today is on the year 2020, we wanted to provide some insight into what transpired in the fourth quarter. Beginning with the chart on the left, as we look back over the year, there was unprecedented growth at the end of the first quarter. In the second quarter, the quarter-over-quarter loan growth rate plummeted to a negative 5.3%. And in 3Q, although still negative, a quarter-over-quarter rate of negative 3.3% was an improvement over 2Q. And now in 4Q, a quarter-over-quarter rate of minus 0.3% is again an improvement over the previous quarter. Contributing to this quarter-over-quarter improvement in 4Q, the chart on the right shows C&I bilateral balances were higher quarter-over-quarter, up 1.3%, while CRE bilateral loans were down a little less than 0.5%, and participation balances were down 2%. Next, on slide 12, we change our focus and look at the year-over-year loan growth. In each of our prior webcasts during 2020, we reported that total loan balances were higher year-over-year. During 4Q20, that changed, as October, November, and December were each lower than their 2019 balances. As of December, total balances were down 0.4% year-over-year. The chart on the right shows that only CRE bilateral loan balances are higher, up 3% year-over-year. C&I bilateral balances finished the year down 1.3%, and participations were also lower in 2020, down 2.1%. On slide 13, we look at the loan growth that occurred during 2020, arrayed across loan size ranges. For all loan types, the chart on the top left, we see loans have decreased in 2020 for each of the loan size ranges less than $25 million in size, while the largest loan size range, greater than or equal to $25 million, posted an annual increase of 4.75%. Similar results are seen for C&I bilateral loans, the top right chart, and C&I participations, the bottom right chart. Again, we see only the greater than or equal to $25 million size range posting increases for 2020. The bright spot this year is CRE bilateral loans and CRE participations. The bottom left chart shows negative growth for CRE bilateral loans in only the less than $1 million loan size range, while CRE participations, shown on the right, are up 3.4% for the year. Now on slide 14, we present a quadrant view showing differences in loan growth by state. The top left chart focuses on year-over-year growth for all loan types and presents the top 5 and bottom 5 states. Here we notice that each of the top 5 states saw significantly higher balances in the securities and commodity contract subsector within the finance and insurance sector. And in the real estate sector, where all but Connecticut saw an increase in loan balances involving renting and leasing real estate in the lessors of real estate subsector. Conversely, in the bottom 5 states, Ohio reported lower balances in the motor vehicle and parts dealers subsector within retail trade, in healthcare's nursing and residential care facilities, and in the manufacturing and machinery and metal manufacturing subsector. Illinois also reported lower balances, specifically in the electrical equipment manufacturing subsector centered on household appliance manufacturing, as well as in wholesale trades, merchant wholesalers, durable goods subsector. But the largest decline in balances for Illinois was seen in the real estate sector, which was down 9.7 year over year. Moving to slide 15, one of the leading indicators for commercial loan growth is real GDP. For the last several years, the 10 largest CBSAs in terms of real GDP have outpaced the rest of the country for commercial loan growth. In other words, cities with the highest levels of economic activity and growth tended to generate the highest levels of commercial loan growth. In our last webinar, the 3Q results showed total loan balances fell across the country. For the markets outside of the top 10 CBSAs, the declines in 3Q more than erased the gains from earlier in the year. That trend continued through the fourth quarter. It will be interesting to see if the markets outside of the top 10 CBSAs are able to reverse course during 2021 and move into positive territory. This is something that we will continue to watch and report on in upcoming webcasts. And if you are interested in looking across your own footprint to pinpoint growth opportunities, our AFS Pricing Service has the data to help you find where loan growth is occurring in today's ever-changing markets. Next, on slide 16, we often see a strong correlation between loan growth and particular industry sectors. Here on the top chart, the finance and insurance sector led total balance growth during 2020. Higher balances in Boston, New York, and Bridgeport, Connecticut for both C&I bilateral loans and participations contributed to this sector's #1 ranking. Higher C&I bilateral loan balances in San Francisco and Los Angeles were also booked in this sector in 2020. For each loan type, balances were significantly below the all-industry averages for 2020 in the following industries: retail trade, most notably in Georgia and Ohio, wholesale trade in Pennsylvania and Georgia, and in the manufacturing of machinery and electronic products in Ohio and Pennsylvania. On the next slide, another factor contributing to overall loan growth is the impact of new and renewed balances. Aggregate new and renewed commercial loan volume was up 2% in December when compared to the same month a year earlier. However, aggregate new and renewed loan balances for 2020 are down 6%. This, coupled with low line utilization in the second half of 2020 and a spike in paydowns in the middle of the year, helps to explain why balances were lower in 2020. To close out the loan growth section of today's presentation, we turn our attention to the growth in the COVID-sensitive industries versus all other industries. The focus here on slide 18 is on C&I bilateral loans. Once again, the COVID-sensitive industries represent sectors adversely impacted by measures designed to halt the spread of the pandemic. Using December 19 as a baseline, COVID-sensitive industries reached a higher peak in 2Q when compared to all other sectors. As loan growth slowed in the second half of the year, we see that the COVID-sensitive industries outpaced the rest of the market, despite falling into negative territory during 4Q. Next, on slide 19, we look at the individual COVID-sensitive industries. Again, we see the COVID-sensitive industries at minus 0.9% fared better than the rest of the industries at negative 3.2%. The sharp increase in line utilization contributed to the loan growth seen in the hotels sector. Experiencing the deepest contraction in year-over-year balance growth at -10% is the retail non-essential sector. Examples of what is included in this sector consist of building material and garden equipment dealers and furniture stores, home furnishing stores, clothing stores, and sporting goods stores. On slide 20, we look at one factor that has a direct correlation on balance growth. That is line utilization. For both the COVID-sensitive industries and all other industries, the aggregate line utilization rates ended the year lower than last year's rates. However, two sectors had higher utilization rates at the end of 2020 compared to last year. As mentioned on the last slide, hotels saw a sharp increase in balances, and we can see here that the utilization rate nearly doubled, which contributed to the higher loan balances. The other sector that saw the utilization rate increase is restaurants and bars, up a modest 2%. Higher line utilization is just one proxy for credit distress, as borrowers tend to tap lines of credit when they have an urgent need for cash. Therefore, it's not surprising to see two industries that have really struggled during the pandemic have higher year-over-year utilization rates. And now we move to the pricing and fee section of today's presentation. With that, I will turn it over to Rob Lynch. Rob?
Thank you, Don. Good afternoon, everyone. In looking at pricing for new and renewed loans, we can see that there were very few changes in the fourth quarter. The chart in the upper right shows there was a small uptick in interest rates for new C&I bilateral loans, while participations, shown in the lower right chart, showed an increase for new loans and no change for renewals in the fourth quarter. All interest rates are in a tight range, with participations and CRE bilateral loans having the highest rates and C&I bilateral loans having the lowest. Next, we'll look at interest rate floors. Interest rate floors could help explain some of the increase we saw in the interest rates on new C&I bilateral loans. In the chart on the left, we can see that the use of floors for LIBOR and prime-based loans over the last quarter is at the highest level seen all year. For the quarter, nearly 1 in 4 LIBOR-based loans is priced with a floor, and 6 in 10 prime-based loans has a floor price. Of the loans that have a floor, depicted in the chart on the right, greater than 60% of those loans for both LIBOR and prime are priced at the floor in December. The floor rate for prime-based loans, shown by the red line, decreased this past year, while the floor rate for LIBOR-based loans, shown by the green line, has remained in a very tight range. On the next slide, these two charts depict interest rate and spread by term for COVID-sensitive industries, that's the chart on the left, and non-COVID-sensitive industries, the chart on the right. You can see that in both cases, spreads, the orange bars, rise sharply beginning in the 1 to 5 year term segment. What's interesting to note is that the non-COVID sensitive industries show higher interest in spreads than the COVID sensitive industries in the greater than 5 year term grouping. This is due primarily to the COVID sensitive subsectors, healthcare facilities, and restaurants and bars. These two subsectors make up a large portion of those loans with a term greater than 5 years. The spread for these two subsectors is 165 and 208 basis points respectively, which is lower than the 225 basis points for the non-COVID sensitive industries. On the next slide, we're going to show the interest rate and spread for all the subsectors that make up our COVID sensitive industries. All of these subsectors have a higher spread than the total for non-COVID sensitive industries, with oil and gas being the highest. Outside of oil and gas, the spreads for the remaining COVID-sensitive industries are distributed within a 53 basis point band, from a low of 162 in leisure travel to 215 for hotels. Next, we're going to talk about fees. Fees represent an additional source of income for the banks, and on this next slide, we can see that fee incidence in the upper left-hand chart decreased slightly for new and renewed loans over the quarter. Compared to last December, fee incidence for new loans is sharply lower, while for renewals, it's only slightly lower. Fee level in the upper right-hand chart has increased for both new and renewed loans over the last couple of months. Fee levels were slightly above those seen a year ago for both new and renewed loans at the end of the year. Fee incidence for the COVID-sensitive industries, shown in the lower left chart, are lower year over year for most subsectors, except for oil and gas and leisure and recreation. Fee levels for COVID-sensitive industries overall, shown in the lower right chart, were lower year over year, but there were some sectors with high levels. Hotels, in particular, showed the highest fee level for these subsectors, followed by retail non-essential, with the largest decline in fee level showing in healthcare facilities. With interest rates low because of the economic crisis brought on by the pandemic, interest revenue is also down for the year. And on the next slide, we take a look at the fees on PPP loans to see how much they help to recoup some of the lost interest revenue. The chart on the left compares interest revenue from 2019 to 2020. And as you can see, there is a decrease of over 120 basis points. The chart on the right shows fee revenue from 2019 and 2020, with the green bar being the fee revenue derived from PPP loans. And as you can see, those PPP fees help to cover only about 25 basis points of the lost interest revenue. This leaves close to 100 basis points of lost revenue for the year for the banks. That covers the pricing and fees section. Next, Jeremy Charlson will cover credit risk. Jeremy?
All right, thank you, Rob. Yeah, so it's definitely a complicated environment right now for commercial loan pricing. And as you pointed out, at least fees on the PPP loans were a bright spot this year. 2020, though, was a challenging year, not only for loan pricing, but also for credit risk. And actually, some of the deterioration that we're seeing in different KRIs may actually understate the true level of credit distress that's going on in the marketplace right now. So things like fiscal stimulus, TDR waivers, loan payment deferrals, all of this has helped dull the impact of the pandemic and the resulting economic recession that is caused. What we can see here, we can see that the effect of that trend on C&I charge-offs. And what we have here, we're plotting the C&I charge-offs over the last 20 years or so, and the gray bars are indicating official economic recessions, including the current downturn on the far right. So during 2020, the C&I charge-off rate actually increased 57%, which was a material increase, but not quite as pronounced as what we might have forecasted a year ago. In fact, during the first year of the Great Recession, C&I charge-offs rose by a rate of more than 83%. It would be inaccurate to say, though, that the default risk has dissipated in recent months. With loan deferrals expiring for many borrowers and banks anticipating offering a second deferral to only a handful of these same customers, charge-offs could very well accelerate in 2021. I think much of that will depend on the vaccine rollout and how quickly battered industries like lodging can bounce back from 2020's challenges. What makes navigating this increase in credit risk so frustrating for banks right now is that they're not only contending with the low interest rate environment, they're also contending with increased default estimates on their commercial loans. From an earnings standpoint, lower net interest margins are compounded by higher loan loss provisions. While some banks have recently released reserves, citing an improved near-term credit outlook, default estimates for C&I loans tell a very different story. As illustrated by the blue series on this chart, the weighted average interest rate for C&I loans fell in December 2020 to a new 6-year low point. Conversely, the weighted average PD for this segment reached a new 6-year high in 2020. Even though loan spreads on C&I bilateral loans have widened in recent months, the increase was more than offset by the deterioration in default ratings. So the result is that banks will need to be more vigilant than ever in balancing risk and return for their key portfolio segments. With that in mind, we know the pandemic has more heavily impacted some industries than others. Hotels, for instance, is a segment that immediately comes to mind. Consistent with earlier sections of this webinar, here we examine the risk compositions between the COVID-sensitive industries and all other sectors to see whether migration and rating downgrades were more pronounced for the COVID-sensitive group. Note here that we're just focused on the C&I bilateral loans. Looking at the left-hand picture, we can see that when the COVID-sensitive industries are excluded from the mix, the risk profile of C&I loans in December is nearly identical to that seen a year ago. When the results for December first came in, we were a little bit surprised the distribution was so stable, and I believe there are a couple of market forces at play here. First, compared with, say, the syndicated segment of the market, the smaller bilateral loans benefited more heavily from loan deferrals, and some banks waited for the deferral period to end before reassessing the risk ratings. Other banks that were more aggressive in downgrading credits earlier in 2020 reported significant reductions in criticized assets in the fourth quarter, helping to smooth out the overall trend. And finally, remember that the left-hand picture excludes the COVID-sensitive industries. And more than one bank that we spoke to said that they've scrutinized the COVID-sensitive group, industries like lodging and oil and gas, much more so than the less vulnerable industries of the portfolio. So they may have been more aggressive in their downgrades for the COVID-sensitive group. We can see some evidence for that statement on the right-hand graph, which has the risk distribution focused just on the COVID-sensitive industries. Here we observe a more noticeable risk migration trend. So you can see, for example, the year-over-year declines in loan balances risk rated 3 and 5, and corresponding increases in balances for risk ratings 6, which is the low pass segment, 7 special mention, and 8 substandard. Still, the migration wasn't quite as pronounced as we were expecting, perhaps reflecting the impact of deferrals on this group of industries as well. Now let's take a look at this same picture, this time for syndicated C&I deals. More so than the bilateral loans, syndications experienced much sharper year-over-year increases in the percentage of loans risk-rated low pass, or 06 in the scale, and criticized, representing ratings 7 through 10. This is true even for the left-hand picture, in which we exclude the industries deemed COVID-sensitive. Here again, deferrals might help explain the picture that we're seeing. One of our clients have told us that most of the assistance that they've given to borrowers, so whether in the form of payment deferrals or some other action, was predominantly directed to the smaller end of the market, meaning that bilateral loans benefited to a larger degree than syndications from this assistance. For the COVID-sensitive industries on the right, the migration from pass to criticized was especially pronounced. Criticized balances for this group more than doubled year over year. And within this group, 2 subsectors, namely oil and gas and leisure and recreation, make up a much larger share of the syndicated exposure versus the bilateral loan exposure. Oil and gas was already on shaky footing before the pandemic struck, and leisure and recreation includes companies like fitness centers that suffered greatly because of stay-at-home orders and other such measures. That's another reason for why the syndications experienced a more pronounced risk migration than we saw for bilateral loans on the previous slide. Lodging or hotels is another subsector within our COVID-sensitive group that really endured a rough year. A colleague of mine actually recently traveled to a popular location in Vermont, and he estimated that the occupancy level at this hotel was only a fraction of its normal occupancy level. Not surprisingly, the risk distribution of hotels experienced one of the most dramatic changes seen this past year. Approximately 2/3 of the bilateral and syndicated loan exposure to hotels is currently risk-rated low pass, or 6 on this scale, as well as criticized, which is the ratings of 7 through 10. For C&I bilateral loans on the left, a whopping 31% of the outstandings in the current month were risk-rated 8 substandard. So really some pretty pronounced risk migration going on in this particular sector. For banks that subscribe to our pricing dashboard service, they're using this tool to see whether changes in risk levels for their bank are on par with the market trends pictured here. And while no two portfolios are identical, understanding the rate of change for your peers can inform your bank's policy on risk rating and downgrades. Now, in terms of actual loan performance, measured here by past due and non-accruing loans, things weren't quite so bad for the overall C&I market in 2020. The charts here actually capture a few interesting events during the period. Let's focus first on the blue bars representing short-term delinquencies for C&I bilateral loans. In April of 2020, the percentage of loans past due 30 to 59 days surged 1.5% comprising 1.5% of all loan balances for all industries excluding the COVID-sensitive industries. And past due loans, short-term past dues, made up about 2.6% of the total balances for the COVID-sensitive group. These were record high past due ratios, in fact, the highest that we've seen over the last 20 years or so. Then interestingly, past due levels fell sharply in the next month. And what happened was that banks were still in the process of approving loan deferrals in April, and in the interim, affected borrowers actually slipped into past due status. More telling is that the percentage of loans on non-accrual, the red series, as well as the sum of all past due and non-accruing loans, the total bar, really didn't deteriorate all that much year over year for the left-hand chart, the picture excluding the COVID-sensitive industries. The right chart focused just on the COVID-sensitive group tells a slightly different story. You can see by the graph on the right that non-accruals for the COVID-sensitive industries rose throughout the year. In fact, the increase in the non-accrual rate for the COVID-sensitive industries was more than 3 times the increase in the C&I average, excluding this group. But this increase could have been a lot worse without payment deferral options granted by the banks and government assistance in the form of PPP and other stimulus programs. The COVID-sensitive industries are a diverse group, and while all components of this group were adversely impacted by the pandemic, some suffered more immediate consequences than others. Oil and gas was already on shaky footing even before the pandemic. You can see that sector pictured third from the right. The non-accrual rate for this subsector is north of 5%, which is the highest of the group. Interestingly, for the bilateral loans in this industry, things didn't get much worse year over year. By comparison, restaurants and bars, which is pictured directly to the right of oil and gas, suffered a very large increase in non-accruals over the last year. Within this industry, limited service and takeout establishments are holding up much better than the full service eateries, which had limitations on indoor dining. By far, though, the largest change in non-performing loans was seen for leisure and recreation, an industry that includes things like fitness centers, sporting events, and amusement parks. You can see the trend for that subsector in the middle of the graph. The percentage of loans past due or on non-accrual is approaching the high rate that we observed for the oil and gas sector. You can see leisure and rec is almost as worse as oil and gas as of the latest reporting period. But all things considered, the story here is not nearly as despondent as what we might have predicted last spring. Of course, it's possible that loan deferrals have masked the true level of credit distress in the market, and 2021 could be the make or break year in terms of credit. But for now, at least, non-performing loans appear confined to only a handful of problem sectors. A neat way to visualize the COVID-sensitive industries is to plot them on a risk-return plane. This allows us to see whether yields are commensurate with credit risk. It's interesting that at the subsector level, returns are not always well correlated with credit risk. For example, the bubble for the hotel sector on the far right straddles the horizontal axes, meaning that its yield is about equal to the C&I average. And yet the weighted average probability of default for hotels is far higher or worse than those seen for most other industries. The size of the bubble on these charts corresponds to the amount of loan balances concentrated in this sector. Notice that the bubble sizes tend to get smaller as you work your way from left to right on this chart. In other words, banks have less exposure to riskier industries. A few banks that we work with have told us that they're actively running off riskier areas of the portfolio, such as oil and gas. Others expect to resume lending to these industries once the economy regains its footing. The outlook for these industries and the credit outlook for the commercial loan market in general will depend greatly on whether a COVID vaccine can be quickly and successfully rolled out. So 2020 really was like a year like no other. Excluding PPP loans, total commercial loan balances were down for the full year of 2020. And again, that's the first time that's happened since the Great Recession. So a really sharp retrenchment that we haven't seen in quite some time. Pricing plateaued in the second half of the year. So while rates did come down, mirroring trends in broader policy rates, we did see through the greater use and frequency of interest rate floors, that trend plateau in the later months of this year. And thankfully, in terms of credit quality, the deterioration that we're seeing really wasn't as pronounced as we might have expected, kind of looking back at the trends a year ago. I think a lot of that was tempered by things like loan deferrals and government and fiscal stimulus. We are seeing, though, some interesting trends for the industries that you might call COVID sensitive, things like hotels and restaurants. We saw for this group of industries, especially, that line utilization is very high, perhaps signaling liquidity and cash flow issues for these borrowers. And similarly, criticized and non-performing loans really increased for the COVID-sensitive group as well. Again, it was not a tremendous increase, but enough to cause some concern as we head into 2021. Thankfully, though, the average floating rate spread for the COVID-sensitive group is higher than the C&I average. So at least to some extent, banks are adequately pricing for the credit risk associated with this group of industries. So as always, we here at AFS are ready to help you navigate these trends. We want to thank all the banks that participate in the pricing dashboard service that fed the data for this webinar. And thanks to all of you on the line today for taking the time to join us. So Renee, I think I'll turn it back to you now.
Thank you, Jeremy. Again, folks, if you have any questions for our presenters, please type those into the question area. And we'll just take a minute to see if anybody has any questions. Just as a reminder, we will be sending out a copy of this deck as well as the ability to listen to the recording again tomorrow, so you can look for that in your email. And Don, Jeremy, and Rob, it does not look like we have any questions today. So with that, I think we can. Good, Jeremy.
I'm sorry, Rand, there's one question I see here about will they receive a copy of the deck today?
Yes, we will be sending that out tomorrow.
Okay, great.
Okay, it does not look like we have any other questions. So we would like to thank everybody for attending, and we will see you at our next webinar. Have a good day.
Thank you all. Thank you, Renee.